Breaking news from global markets, and the numbers you are about to hear are not projections. They are not worst-case scenarios. They are happening right now in real time as you watch this. Welcome back. If you're new here, welcome. Because today's video is the one I genuinely wish I didn't have to make. We have covered the missiles, we have covered the interceptions, we have covered the military strategy, but today we are talking about something that will hit every single person watching this, whether you live in Tel Aviv or Lahore or London or Tokyo or New York. We are talking about the money, the staggering, almost incomprehensible financial destruction that this war is generating every single hour. And once you see these numbers, real numbers from real institutions, the question you will be asking is not, when does the fighting stop? The question you will be asking is, can the world economy survive long enough for it to stop? Let's get into it. Let's start with the United States, because this is where the scale of what's happening becomes almost impossible to process. Congressional sources told U.S. broadcaster MSNBC that this war is costing the United States an estimated $1 billion every single day. One day later, Politico reported that Republican members of Congress are privately worried the actual figure is closer to $2 billion per day. $2 billion per day. That is not a budget line item. That is not a rounding error. At $2 billion a day, you are burning through the annual GDP of a medium-sized country every 2 weeks. The Penn-Wharton budget model, one of the most respected independent economic analysis units in the United States, confirmed to Al Jazeera that the war could cost America $2 billion per day in its early stages, and the Pentagon has already asked Congress for an additional $200 billion in supplemental war funding, on top of everything already spent. $200 billion in supplemental funding for a war that was described at the outset as a targeted operation to degrade Iran's nuclear capabilities. House Minority Leader Hakeem Jeffries stood at a Capitol Hill press conference and said, and I want you to hear this directly, Trump is plunging America into another endless conflict in the Middle East and spending billions of dollars to bomb Iran, but they can't find a dime to make it more affordable for the American people to go see a doctor. That is not a partisan political statement. That is a description of a resource allocation crisis happening in real time inside the world's largest economy. Now let's go to Israel, because what Israel's own finance ministry is saying about the economic cost of this war should be front-page news everywhere. Israel's finance ministry officially warned that the air conflict with Iran could damage the Israeli economy by over 9 billion shekels, that is approximately $2.93 billion every single week. Every week, not every month, every week. Under the current Homefront command restrictions, the red alert protocols that shut schools, limit movement, mobilize reservists, and freeze normal economic activity, the finance ministry estimated weekly damage at 9.4 billion shekels. That is over $3 billion per week, draining out of a single economy. Credit card purchases inside Israel fell by 19% in the first 10 days of the war compared to average spending levels at the start of the year. Schools remain closed across large parts of the country. The northern half of Israel has been functionally paralyzed. And Israel's defense establishment has been demanding more. In closed discussions with Prime Minister Netanyahu, defense officials pushed the defense budget demand to 177 billion shekels, a figure that has already grown from 112 billion when it was set in December to 144 billion and is still climbing. Israel's fiscal deficit target jumped from 3.9% of GDP in December to 5.1% last week. Investment analysts at Mitav consider 5.5% more realistic, and that assumes the war lasts only 4 weeks. The Bank of Israel considers even the government's own growth projections overly optimistic. This is not a country absorbing economic pressure. This is a country whose financial foundations are being actively eroded week by week, wave by wave, billion by billion. Here is where the story leaves the Middle East and arrives at your doorstep, wherever you live. Global stock markets have already lost an estimated $6 trillion in market capitalization since this war began, according to Bloomberg. $6 trillion. Gone. Not transferred, destroyed. The Dow Jones fell over 400 points in a single session. The S&P 500 dropped. European and Asian indexes fell between 1% and 2% on single trading days, reflecting the fear of what sustained energy supply disruption means for industrial economies. The Nasdaq has entered correction territory. The US dollar has risen 2.4% this month as investors flee to perceived safety. Bond prices have fallen, pushing yields higher at exactly the moment the Trump administration is seeking $200 billion in new war spending, creating a debt pressure spiral that bond traders are watching with genuine alarm. Traders are now pricing in zero interest rate cuts from the Federal Reserve for the entire remainder of 2026. At the start of this year, markets expected multiple cuts. That expectation is gone, because when energy prices are surging and inflation is climbing, central banks cannot cut rates to stimulate growth, and they cannot raise rates without crushing the economies they are trying to protect. That is the stagflation trap, and the global economy is walking directly into it. Let me give you the oil number. because this is the number that connects every other number in this video. Before this war began on February 27, 2026, Brent crude oil was trading at approximately $72 per barrel. As of this week, Brent crude has been trading above $106 per barrel. That is an increase of more than 40% in less than 30 days. The International Energy Agency, the IEA, described the situation caused by this war as the greatest global energy security challenge in history. Not in recent history, in history. The Strait of Hormuz, the narrow waterway through which approximately 20% of all global oil and gas supplies transit, has been effectively disrupted since early March. Iran threatened to block it entirely. An IRGC official publicly stated he would, and I am paraphrasing here, set fire to any ship coming through the strait. Saudi Arabia had been rerouting oil exports through the Red Sea to bypass Hormuz. Iran has now threatened the Red Sea as well. When 20% of global oil supply cannot reliably reach its destination, the price of the 80% that can still move goes up for everyone, everywhere, not just in the countries directly involved in the conflict. Fuel prices for consumers across Europe are up. Manufacturing costs for factories in Asia are climbing. Fertilizer prices, which are directly linked to natural gas prices, are rising. And rising fertilizer prices mean rising food prices, not in 6 months. Now, let's talk about Europe, because what is happening to European economies right now is something that the ECB's own language is struggling to adequately describe. The European Central Bank postponed its planned interest rate reductions on March 19th, raising its 2026 inflation forecast and cutting GDP growth projections simultaneously. That combination, rising prices, falling growth, is the definition of stagflation, the economic condition that policymakers fear above almost all others because it eliminates the standard tools for addressing either problem without making the other worse. Flash Purchasing Managers Index surveys from S&P Global released just days ago showed Eurozone business activity losing momentum sharply in March. Input costs rose to their highest level in more than 3 years. The Eurozone composite PMI came in at 50.5, barely above the stagnation threshold of 50, down from 51.9 in February. Chris Williamson, chief business economist at S&P Global Market Intelligence, said directly, "The flash Eurozone PMI is ringing stagflation alarm bells as the war in the Middle East drives prices sharply higher while stifling growth." He added, "The drop in future output expectations was the largest recorded since Russia's invasion of Ukraine in 2022. Germany, Europe's largest economy, is at high risk of recession according to the IFO Institute. So is Italy, so is the UK, where inflation is expected to breach 5% in 2026. Chemical and steel manufacturers across the EU and UK have already imposed surcharges of up to 30% to offset surging electricity and feedstock costs. Economists are warning this could lead to permanent deindustrialization in some sectors, not temporary disruption, but permanent structural damage to European industrial capacity. The ECB is, in the words of one economist, no longer in a good place. That is the most significant piece of understatement in contemporary economic commentary. The pain is not limited to America, Israel, and Europe. The countries that are suffering most, the countries where this economic destruction translates most directly into human suffering, are in Asia and the developing world. India relies on the Persian Gulf for nearly 60% of its petroleum imports. The same region is the source of over $125 billion in annual remittances sent home by a diaspora of primarily low-income workers whose earnings support millions of Indian families. Following the drop in LNG output from Qatar, which suspended production after its Ras Laffan facility was struck, India was forced to cut production at 3 of its own urea plants. Urea is fertilizer. Fertilizer means food production. India accounts for approximately 25% of global rice exports. When Indian urea plants shut down, it is not just an Indian problem. Japan's Nikkei index dropped over 2% in a single session. South Korea's market fell nearly 3%. The Philippines declared a state of national energy emergency. On March 2nd, Pakistan's KSE 100 index recorded its largest ever single-day decline. Kuwait, which depends on Iran-adjacent oil exports through the strait, and on desalination plants for nearly all its drinking water, and which has seen those desalination plants struck by Iranian missiles, faces a Goldman Sachs projection of up to a 14% GDP contraction this year if the war extends into April. 14%. That is not a recession, that is an economic collapse. The Suez Canal, already impacted by the Red Sea crisis, is experiencing declining shipping activity that the World Bank estimates is costing approximately $10 billion in losses. Egypt, which depends on Suez Canal revenues for a significant portion of its national income, is watching its fiscal position deteriorate in real time. Let me give you the full picture in a single set of numbers. The US, $1 to $2 billion per day in direct war costs. Israel, $3 billion per week in economic losses. Global stock markets, $6 trillion in market cap destroyed. Oil prices up more than 40% in 30 days. Global GDP revised downward by 0.3 to 1% by economists, and that range gets wider every week the war continues. Deutsche Bank, Oxford Economics, and the European Central Bank are all now using the word stagflation, the combination of rising inflation and stagnating growth, to describe where the global economy is heading if this conflict does not resolve quickly. Oxford University's economics department has modeled scenarios in which Brent crude hits $140 per barrel for 8 weeks. The results: mild contractions in the Eurozone, the UK, and Japan, and what they described as a temporary standstill in the US economy with unemployment rising. And $140 oil is not a theoretical extreme in the current environment. It is a threshold that market analysts are actively discussing. Stefan Angrick, Japan economist at Moody's Analytics, put it plainly: there is no Goldilocks scenario where the conflict ends and everything just snaps back to the way it was. Read that again. There is no snapback. Even if a ceasefire happens tomorrow, the structural realignment that this conflict has triggered in energy markets, in supply chains, in manufacturing costs, in food prices, in debt loads will persist for months, for some sectors, years. Here's the question that economists are running scenarios on right now in institutions like Oxford, Deutsche Bank, Penn Wharton, and the IMF, and that nobody in a government press conference wants to answer directly. What happens to the global economy if this war continues at current intensity for another 60 days? At $2 billion per day for the U.S. alone, that is an additional $120 billion in direct war costs, before the $200 billion supplemental funding request is even processed, before interest on the debt generated by that spending compounds, before the secondary effects of sustained 100+ oil on inflation feed through into consumer prices, wages, central bank decisions, and growth projections across every major economy on Earth. The Gulf states, Saudi Arabia, UAE, Kuwait, Qatar, collectively hold approximately $4 trillion in sovereign wealth fund assets invested in Western economies. If the energy shock forces those states to liquidate holdings to cushion domestic revenue collapses, the resulting asset sales would hit stock markets, bond markets, and the AI investment ecosystem, where Gulf sovereign funds have deployed tens of billions of dollars simultaneously. One analyst described this scenario as threatening to burst the AI bubble and destabilize U.S. treasuries. That is not the language of a tail risk. That is the language of a systemic threat. The IEA called this the greatest global energy security challenge in history. Bloomberg reported $6 trillion in market cap destroyed. The U.S. is spending up to $2 billion per day. Israel is losing $3 billion per week. Oil is up 40% in 30 days. Europe is staring at stagflation. Asia is paying an energy bill it cannot absorb. The developing world is watching food prices climb because fertilizer prices are climbing, because gas prices are climbing, because the Strait of Hormuz is in the middle of an active military conflict zone, and the Pentagon wants $200 billion more. History gives us a clear record of what sustained oil price shocks produce. The 1973 crisis, the 1978 crisis, the 2008 spike. Every significant oil price shock in modern history has been followed in some form by recession or stagflation in the economies most exposed to it. Economists at multiple institutions are citing that historical pattern explicitly right now. The difference this time is that the shock is not coming from one source. It is coming from simultaneous disruptions to the Strait of Hormuz, the Red Sea, Qatar's LNG exports, Gulf state energy infrastructure, and global investor confidence all at once, all compounding each other, all while the conflict that is causing them shows no clear pathway to resolution. Billions are burning, every minute, not as a metaphor, as arithmetic, and the clock is not slowing down.